Welcome to Nasdaq Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq. Joining us for this segment, we have Mish Schneider, Director of Trading Education at MarketGauge, to help us make some sense of the volatile action that we're seeing in the market. Mish, it's great to see you as always. Welcome back to Trade Talks. And I want to kick it off and talk about the IWM, because we focus on this as it really is a critical component of the market to kind of gauge sentiment.
Absolutely. Although we're finally seeing some corrections in these growth stocks that many would have felt were overvalued to begin with, one of the reasons why they look so overvalued was because the small caps have underperformed the Nasdaq and the semiconductor stocks and those big growth stocks for a long time now. And part of it had to do, obviously, with interest rates. With zero rates, those stocks were really able to prosper, whereas Russells represent more of the manufacturing industrial side. Somewhat interest rate sensitive, of course, but not as bad. So what we really want to see at this point, for people to be able to say, the bottom is in, it's time to buy, would really be, I'd say, leadership from the Russell 2000 to finally start to outperform, hold up. We've got this really interesting trading range that's just gotten everybody crazy, stuck. But if you buy at the bottom and you're wrong, you know it right away. And as soon as it rallies, you got to get out, active market. And at this point now, the macro on terms of the manufacturing industrial with GDP is at this point not really showing any signs of growing. So yeah, we're cautious.
Yeah, well, look about the debt record high, right, as it relates to GDP.
Absolutely. I mean, we were at over 133 trillion as part of the GDP on the debt. And it doesn't look like it's going to abate because they're talking about sending $33 billion more to Ukraine. And I don't think that's going to be the last time we're going to be sending money to Ukraine. So yeah, this government debt's an issue versus the GDP, and it's highly inflationary.
Yeah, well, let's talk about valuations for a moment, too. Of course, we're in the thick of earnings season. One thing, to your point earlier about this market, certainly is the stock pickers market, certainly requires active management, and we have to justify these valuations at some point. We're seeing companies make quarters, but they're getting trapped with the guidance going forward. And, you know, Q1, we weren't seeing the inflation like we're seeing as much as we are in Q2. I think guidance and what these numbers are going to look like in Q2, Q3 really are going to matter.
Jill, you're absolutely correct. Let's look at Apple, perfect example. So they reported really well. And the initial reaction, of course, was up. But then the conference call happened. And what did they talk about? Supply chain issues, less orders for their iPhone going forward, problems in China, obviously, with some of the labor issues because of the shutdowns. And I think that's really sets the theme for what we've seen, let's say, with Amazon, another great example. The consumer spender is just not going to be robust the longer we have an inflation narrative. And that doesn't look like that's going away anytime soon either.
Yeah, well, I mean, let's talk about China for a moment here, loosening restrictions on tech. So is that a potential catalyst to get a little bit long here?
Well, we actually did put our fund and our service members into FXI today a little bit, just to kind of test the waters because of the nice gap up. But they're doing two things. Number one is where they had restrictions in tech and we didn't, they're loosening the restrictions. And we're actually talking about adding restrictions, particularly with Google. And number two is while we're talking about QT, they're talking about QE. So there's always been chatter through the years I've seen about the arbitrage, buy China, sell the US, and that hasn't worked at all. But maybe this year we'll start to see that actually come to fruition. So yeah, we tested the waters. We didn't buy a huge position, but we, as they say, dipped our toes in.
And finally, Mish, I want to talk about gold for a moment here. I mean, we have to talk about the commodity space, especially, you know, as it relates to what's happening in equities, as well as the inflationary environment, and also what's happening with the dollar.
Well, one of the charts that I sent you, I thought was really a brilliant chart to look at, and it shows the commodities through the years in inflationary periods and deflationary periods, and then the relationship of gold to SPX during those times. And so obviously in the 70s, gold outperformed, and in inflationary times, gold will ultimately outperform everything else. Oil may start, grains may follow, softs may follow, copper wood may follow, but gold will continue while they flatten out. And during that 70s period into the 80s, you can see that gold well outperformed the SPX. So now everything else that we're talking about here, if you look at right now, gold is still not broken out in terms of its relationship to the SPX and in terms of inflation. So that makes gold, for so many reasons, incredibly undervalued. And I still believe probably one of the best opportunities going forward for at least the next 6 months, maybe even the next couple of years.
All right, Mish, appreciate the insight as always. Thanks for joining us on Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.